Welcome to an in-depth exploration of PayPal, one of the world's leading digital payment platforms. In today's analysis, we will unravel the intricacies of PayPal's business model, its growth drivers, competitive landscape, and unique challenges it faces. From its two-sided network connecting millions of merchants and consumers to its ambitious super app aspirations. PayPal's story is one of innovation, entrepreneurship, and strategic positioning. Join us as we dissect the company's financials, evaluate its performance through key performance indicators, and delve into the controversies and criticisms that shape its current standing in the market. Whether you're an investor, a merchant, or simply curious about the future of online payments, this comprehensive overview offers valuable insights into a company that continues to redefine the way we transact in the digital age. Let's begin. How PayPal operates in a nutshell? Well, PayPal operates a global two-sided payment network, connecting 35 million merchants with 400 million consumer accounts. 92% of PayPal's revenues come from transaction fees known as take rates. These fees vary based on the type of service provided. Now let's get into PayPal's core services. Well, PayPal branded checkout and digital wallet allows online merchants to accept payments from PayPal's digital wallet users, charging a fee of 3.49% plus a fixed fee of 0.49 cents per transaction. Then they have Braintree or unbranded processing, which was acquired in 2013, and Braintree offers end-to-end e-commerce payment processing at a likely take rate of 1.5 to 1.75%. Then we have Venmo, which is also a digital wallet known for free peer-to-peer payments, and Venmo is being monetized through various services like debit and credit cards and merchant transactions. It's a pretty popular platform among millennials in the US. Then we have other merchant services which include inventory management, risk and fraud solutions, and point-of-sale software and hardware. And finally, other value-added services, which comprises revenues from partnerships, interest revenues, and other miscellaneous sources. So, PayPal economic model consists in revenue generated by multiplying transaction volume by a spread or take rate, with costs divided into transaction expenses and operating expenses. What are PayPal's growth drivers? Continued growth in global e-commerce is a tailwind for PayPal, as well as expansion into new geographies, which offers significant potential. Then we also have Venmo's under-monetized platform, which presents an opportunity for revenue growth, digital wallet growth, which is expected to see strong recovery and growth in the coming years, buy now, pay later services, in short form BNPL. So PayPal leads in BNPL transactions, driving increased transaction volume, and super app ambitions, which PayPal aims to become a super app for payments, shopping, and financial services. In summary, PayPal's business model is the following. PayPal earns money by taking a fee as a percentage of total payment volume, with the fee declining as the company diversifies its services. The company pays out the networks they use, generating gross margins on transactions of approximately 60%. Now let's take a look at the business economics and its key figures. So as of 2022, PayPal has 435 million active users, comprising 400 million customers and 35 million merchants, as I already mentioned. They processed 22.35 billion transactions during the year, with an average dollar amount of $60.7 per transaction. When considering all expenses, the cost incurred by PayPal is $1.06 per transaction. This includes all costs, like fixed costs from transactions as well as operating costs. The cost would be lower if only fixed and variable costs per transaction were taken into account. So how should we measure PayPal? I would evaluate the company's performance using these key performance indicators. First one, we have total payment volume, TPV, which was 1.36 trillion as of 2022. Secondly, we have number of payment transactions, which was 22.3 billion as of 2022, as I already mentioned. Thirdly, we have active accounts, which was 435 million. Payment transactions per active account, which was 51.4 as of 2022. And this is very important because you can have a lot of active users, but if they only make one transaction a year, it doesn't count as much. Then I would also take into consideration take rates and net income. So, I'll start with the bad news. There's much about this business that I find concerning. PayPal's middleman position and risk of becoming a commodity limit its pricing power and force constant enhancements to stay competitive. This could lead to irrational innovation such as crypto and price wars. I'm also troubled by the terms PayPal offers to small merchants, such as freezing their accounts. After extensive research, I found general dissatisfaction with their terms and services, particularly as a credit and debit card processor. However, merchants continue to use PayPal for its easy setup and high conversions, thanks to network effects. Now, let's take a look at competition. Competition is an intriguing topic for PayPal, a company that has faced much criticism in this area. My goal is to provide an objective and rational analysis independent of news and investor real opinions. PayPal's main competitors are, firstly, Square, which offers point-of-sale systems for card payments and business services. Secondly, we have Stripe, an online payment processor for accepting payments and managing financial operations. Third, Adyen, a global platform for accepting payment in multiple currencies. Fourthly, Amazon Pay, Amazon's digital wallet for online purchases. 5. Google Pay, Google's wallet for in-store, online and peer-to-peer payments. And last but not least, Apple Pay, Apple's services for payment using Apple devices. As the saying goes, the news follows the stock price, not the other way around. And PayPal exemplifies this. These two charts reveal that PayPal retains a significant share of the online payment market. Although competition is growing, so is the market itself. This leads me to believe that even if PayPal loses some market share, it will remain a leader in the mid to long term, well positioned to capitalize on the growth of e-commerce and online payments. Some argue that competition explains why PayPal stock has declined 80% from its all-time highs. However, I see the decline more as a result of over-optimism and short-term thinking about the company's growth trajectory, along with assumptions about the sustainability of pandemic tailwinds. Missing Wall Street's estimates for several consecutive quarters also has contributed, as analysts really just care about this. In conclusion, while competition is intense and PayPal's middleman position may not be optimal, the fear appears excessive when considering the company's current standing and performance. However, it's essential to remember that past or current numbers are not guarantee of future success. Now let's analyze PayPal's moat. PayPal has the benefit of being the first mover, has a great history and represents entrepreneurship, safety and speed. For example, when I used to resell sneakers, PayPal used to be the go-to payment method because it would be the fastest when entering raffles and the checkout process was so much easier. This guaranteed better odds of renting the sneakers. Google Pay has recently been a competitor on that side, but being platform agnostic gives PayPal some advantages. PayPal operates a large two-sided network with 35 million merchants and 400 million consumers, making it one of the biggest payment networks outside of China, giving it a huge advantage thanks to its network effects. Merchants can accept payments through PayPal's various services, including its digital wallets, credit and debit cards, cryptocurrencies and more. According to Comscore, PayPal improves sales conversion by 60% compared to other methods. PayPal is accepted at 79% of the top 1,500 US and EU online retailers versus just 28% of Apple Pay, 15% of Amazon Pay and 7% of Shop Pay. Overall, I believe the company has some competitive advantages, but due to structural factors, they will never free themselves from being the middleman and being squeezed by both sides, customers and big merchants. Other advantages PayPal has over competitors include being platform agnostic, meaning they are not limited to a specific operating system or platform like Amazon Pay, Google Pay or Shopify Pay. They are a convenient solution for small merchants, leading to habitual use as businesses grow. Even though switching costs are insignificant, the habit often remains in place. I've seen cases where merchants are dissatisfied with the service but haven't changed providers for over a decade for some reason or the other. Now let's take a look at their key financial figures. Net income has remained fairly stable over the last 5 years with a dip in 2022, but a strong recovery this year. It's noteworthy that 2023's net income is only about 150 million shy of that one of 2020's, even though the stock price is nearly 5 times lower. Gross margin, though slightly declining, have consistently remained over 40%. Net margins, though not in my preferred range, are high for the industry and have returned to pre-pandemic levels. Finally, SG&A accounts for around 30% of gross profit, which is pretty good, and interest expenses are well below 15% of operating income, which is perfect. Now let's analyze their capital allocation. Regarding capital efficiency, return on invested capital or ROIC is disappointing. Yet they've delivered notable ROEs despite some volatility, and ROCE, which is return on capital employed, has consistently remained above 12%. The capital has been allocated mainly to 1. Share buybacks. PayPal has consistently bought shares on the open market, primarily to offset dilution from stock-based compensation, though the number of shares outstanding has slightly declined. It's notable that they've increased buyback activity after the stock decline, even after buying at all-time highs. Then we have acquisitions with names like Honey, Paydi, iPose, Zettle, Xoom, Braintree, Hyperwallet Systems, and Venmo. And finally we have CapEx. Currently, PayPal is trading at 2017 valuations, despite being a larger and improved business. Its trading multiples are at all-time lows, even compared with 2017. I think their PE was 30 around that year, but now it's around 16 if I'm not wrong. A reverse discounted cash flow model using very conservative assumptions, including a terminal growth rate of 0%, suggests that the implied growth rate as of 24 of August of 2023 is around 4%. Now let's take a look at the risks. Some of the risks are lawsuits, and for more details I suggest you reading the 2022 annual report. Then we have intensifying competition with players such as Apple, Amazon, and many others. Management vacuum, which creates uncertainty. Recently they have changed CEO and CFO, and this may create some uncertainty even for investors and for employees. The stock could still get cheaper, even though it's very cheap right now, or it looks like it could still go down, so that's a risk. And finally we have capital misallocation. Now let's get into my thesis and conclusion. PayPal may not be what I'd call my ideal hold forever investment, but I see an attractive opportunity at this cost basis. Following Peter Lynch's advice to invest in what to use, I'm a satisfied PayPal customer and understand the business. The market seems to be pricing it as a slow growth entity for the next decade, and that's where I see potential. Simply put, I believe there is an asymmetric probability that the business will grow more than what's currently reflected in the stock price. In conclusion, from my perspective, this will not follow Charlie Munger's principle of buying a great business at a fair price, but maybe you're going to buy a fair business at a great price. And I believe that with the right time horizon for holding the stock, there might be some significant upside. Just remember, I'm not recommending to buy, and I'm not saying it's a bad business either. I'm just saying that it's not a great business at a fair price. As always, remember, I'm always open to changing my mind if any relevant facts are presented, and I hope to be learning from your opinions and your thesis and also your arguments. Thank you so much.